Hello, everybody. Welcome to Thursday. The S&P 500 was down 0.04% today, so basically just flat. However, it was up for most of the day, and it really sold off right at the end of the day to get back down to where it started from in the end. I think the big takeaway message today, though, has more to do with the bond market. The House passed their version of the tax cut bill this morning. The market for the bond market actually ended up. It depends on what measure you look at, but maybe a 0.25% across a broad range of the treasuries. And so that's a interesting sign because what we were looking at yesterday was the stock market was down 1.6%. The bond market was down based on a poor treasury auction for 20-year treasuries, and also based on the fact that they increased the amount of tax cut, which is just less revenue to the country, which means a higher deficit. And then last night, they hardline Republicans that are in the House got some of their spending cuts pushed in there, which I haven't seen a number yet, but the number before these spending cuts were put into place was going to be about a $3.2 trillion increased deficit over the 10-year period on a projection basis, and most likely be higher because it always is. But nonetheless, I would bet that now that on a projection basis with these new spending cuts that are coming in, they're basically coming in a little bit earlier. You'll end up with a situation where it's probably in that high $2 trillion deficit. So bond market is the one that you want to look at to see, what does the bond market think about that, especially the treasury market, because the treasury market is going to be the one that has to issue these new treasuries to cover that deficit, to cover other spending programs as they come up, to cover stimulus programs if we end up in a recession, et cetera. So that's where that bond market's really super important. So I think that was a good sign that the bond market was up today. We'll see what happens going forward here. And obviously, that's not the final bill. Now the Senate has to take it and do some work. It could come back to the House, et cetera. Again, I said yesterday that the 2017 cut was signed in early December of 2017. So we probably have a ways to go before they really get into the details, because there's still a lot of broad pieces in these bills right now in terms of what is going to be cut exactly, and how much and such too. So you'll be going through that process for a while. However, if you look at kind of what is not being talked about, which I think is kind of interesting, and it's something to keep in the back of the mind, we're at someplace in the 14 to 17% net tariffs. I keep seeing different numbers from different calculations, but we were at 27%. So obviously we've come down quite a bit with that drop from 145% on China, and so how does that work, right? But more importantly, does it work in terms of bringing revenue into the country? They can't count tariff revenue as part of this reconciliation process. So if we're, say, $3 trillion, projected deficit for the next 10 years, you could have money coming in from tariffs, so you can't count that against that in that process. And so but it's out there. I don't know if they're going to stick. I don't know if they're going to be higher or lower. I don't know if we'll be able to collect them all. There's some problems with how you collect them, and there's all kinds of different ways of kind of dodging these things. I don't know if we hit a recession or what have you, but there will be revenue, at least for some period of time, coming in from tariffs. And that's something the bond market's got to think about also, just in the standpoint of, hey, we got this deficit, we're going to have to issue these bonds, but if they can pay some of the bills with the income coming in from these tariffs, then maybe not as many bonds have to be issued. And it's possible you can collect enough tariffs in theory to cover, a lot of that deficit. So that's a piece that's out there. I guess that would be a positive on the tariffs. The problem with tariffs is that historically they've caused economic slowdowns, higher unemployment. And so, that would make it the opposite. In other words, yeah, they're collecting money, but there's even less tax revenue coming in because the economy is sinking. And so, we'll see how it's done. It's possible that there's some number on tariffs that could still work and not slow down the economy so much. I still think we're probably a little bit high here to be there, but we can't tell. I mean, honestly, the number of organizations that are in the supply chain that could absorb some of those tariffs is quite high, and so you've got all kinds of potential outcomes that could happen, and that's what we're going to be finding out here between now and say September, October, I think we're really going to start to learn about, how much does this actually increase costs, especially to the consumer level? How much does this impact earnings, on the stock and retailer level or whoever it is, as far as that goes, and how does that translate in overall? When costs do go up, people buy less, and so we'll have to see if they do go up. Again, I know a lot of people are taking views for what's going to happen. I would say keep an open mind because we really don't know. I mean, costs could go up dramatically. They could go up that not at all. It really depends on who's absorbing these situations. Again, looking at the 2018 tariffs, about half that tariff was passed through to consumers in higher prices. So if we had a 14, 17%, you could get 7, 8%, jump in cost, which would be a big deal, actually. Now, not everything would be at that level because it's all different places, but, that's interesting. Now, the one thing about tariffs that's interesting, it is a one-time thing, right? So you get this big jump. And then, when you start to look at year over year inflation, it'll be quite a bit higher, and until all of a sudden you get past a year, and then we'll get back down to the other areas. So, kind of what happened in 2022 when the cost jumped up, and then we got back to kind of normal, like 2 to 3% growth in costs after that. It could be very painful, especially if wages don't keep up and those types of things. But again, this is different. We don't know what that's going to be at this point in time. So I think we have to kind of, watch and see. We'll learn a lot here as this goes on. And then again, I mentioned yesterday, tariffs are optional, so they can reduce tariffs if it's not working. They can reduce tariffs, and they've shown some willingness to have some flexibility, actually, especially when things really start to have problems. So we'll see. I don't think they want to be heading into the midterms with costs going up and up and up and up. If they can maybe dial tariffs back a little bit and get that to go away, that might be important. But again, we don't know that costs are going to go up yet or not. So anyway, that's what's going on today. Not a bad time to be out there. The market is, doing okay, but very happy to see that the bond market did well today, considering looking at this tax bill. All right. Thank you very much. Talk to you later.